Something happened in the markets that caught millions of investors off guard. Gold and silver, those ancient stores of value that had been climbing steadily for months, suddenly reversed course with stunning force. Billions of dollars in paper value evaporated in a matter of days. Portfolio screens turned red. Panic spread through trading forums and social media. And behind it all stood a number that demands our attention: $6 trillion. This isn't just another price fluctuation. This represents a fundamental shift in how capital is moving through the global financial system. Understanding what happened here and why may be one of the most important financial lessons you learn this year. My name is here to walk you through this moment with clarity and calm, not to create alarm, but to build understanding, not to chase headlines, but to examine the forces that actually move markets. If you own gold or silver, you need to understand what just happened and what it means for your holdings going forward. If you've been watching these markets from the sidelines, you need to understand whether this represents danger or opportunity. Either way, emotional reactions will cost you money, knowledge and discipline will protect you. So let's begin with the essential question: what actually happened? The simple answer is that a massive reallocation of capital created sudden downward pressure on precious metals prices. But that simple answer conceals layers of complexity that every serious investor must understand. We're going to examine the mechanical forces that created this shockwave. We're going to explore the psychological dynamics that amplified it. And we're going to discuss what rational, disciplined investors should be thinking about right now. This won't be quick or simple. Real financial understanding never is. But if you stay with me through this analysis, you'll emerge with a framework for thinking about not just this event, but future market disruptions as well. Because here's the truth that most financial media won't tell you: this will happen again. Perhaps not to gold and silver specifically, perhaps not with the same magnitude, but sudden, violent market reversals are a permanent feature of modern financial markets, not a temporary bug. The question is whether you'll be prepared. Let's establish the foundation. What does $6 trillion actually represent in this context? This figure refers to the approximate size of global monetary interventions, policy shifts, or capital flows that created the conditions for this precious metals correction. The exact composition matters less than understanding the scale and the mechanism. When capital on this magnitude begins moving, it creates gravitational effects throughout the entire financial system. Nothing remains untouched. Stocks, bonds, commodities, currencies, real estate all feel the pull. Think of it this way. Imagine an enormous cargo ship changing direction in a harbor. The displacement of water affects every smaller vessel nearby, even those that aren't directly in the ship's path. Financial markets work the same way. This particular shockwave originated from a combination of central bank policy adjustments, sovereign wealth fund repositioning, and institutional portfolio rebalancing. The technical details are less important than grasping the fundamental dynamic. When this much money moves, price discovery becomes temporarily distorted. You might ask, if this was a general market event, why did gold and silver experience such pronounced pressure? The answer lies in the unique position precious metals occupy in the modern financial ecosystem. Gold and silver serve multiple roles simultaneously. They are monetary metals with thousands of years of history as stores of value. They are industrial commodities with actual use cases in manufacturing and technology. They are portfolio hedges against currency debasement and systemic instability. And they are speculative assets that attract momentum traders during volatile periods. This multiplicity makes them vulnerable to rapid repositioning. When massive capital flows create sudden shifts in currency valuations, interest rate expectations, or inflation forecasts, precious metals become a natural pressure point. They sit at the intersection of monetary policy, commodity markets, and investor sentiment. Consider what happens when major institutions decide to reduce their precious metals exposure even slightly. A sovereign wealth fund adjusting its allocation from 5% to 4% in gold doesn't sound dramatic. But when you're managing hundreds of billions in assets, that 1% represents billions in selling pressure. Multiply this across dozens of large institutions, making similar adjustments within a compressed time frame, and you create the conditions for a cascade. Let's examine how price pressure actually manifests in precious metals markets. Unlike stocks, where each company has a defined number of shares outstanding, gold and silver trade across multiple interconnected markets simultaneously. There's physical metal, there are futures contracts, there are exchange-traded funds, there are options, swaps, and various derivative instruments. These markets normally maintain rough price equilibrium through arbitrage. When they diverge significantly, traders profit from the gap, which naturally brings prices back into alignment. But during periods of extreme pressure, this mechanism can break down temporarily. Imagine a futures trader who needs to sell large positions quickly. They don't have time to wait for buyers at current market prices. They accept lower prices to execute immediately. This creates a new, lower reference point. Other automated trading systems see this lower price and adjust their own algorithms accordingly. Stop loss orders trigger automatically. Margin calls forth additional selling. A feedback loop develops. Meanwhile, the physical markets move more slowly. Dealers and collectors don't make instant decisions based on futures prices. This creates a temporary disconnect between paper and physical markets. This disconnect is crucial to understanding what happened. Paper markets led the decline. Physical markets followed more gradually. And that gap created both panic and opportunity, depending on how you understood what was actually occurring. None of this is unprecedented. Precious metals have experienced violent corrections throughout modern financial history. In 1980, gold peaked near $800 per ounce before collapsing by nearly 2/3 over the following years. Silver experienced an even more dramatic rise and fall during the Hunt Brothers episode. In 2011, gold touched $1,900 before entering a multi-year bear market that took prices back below $1,200. In 2020, another rapid rise was followed by sharp correction. The pattern repeats because the underlying dynamics repeat. Periods of monetary uncertainty drive investors toward precious metals. Prices rise. Momentum attracts speculative money. Prices rise further. Then some combination of policy shifts, sentiment changes, or technical factors triggers reversal. What makes each episode different is the specific catalyst and the broader market context. But the fundamental pattern, accumulation, acceleration, exhaustion, correction, remains remarkably consistent. Understanding this pattern doesn't make the corrections painless, but it does provide perspective. It reminds us that violent price movements in both directions are normal features of these markets, not aberrations. Now we need to discuss what was happening inside the minds of market participants as this unfolded. Human beings are poorly equipped for rational decision-making during rapid financial losses. Our evolutionary wiring optimized us for physical survival threats, not portfolio volatility. When you see your account value dropping rapidly, your amygdala activates. Stress hormones flood your system. Your time horizon compresses. The long-term reasoning that guided your initial investment disappears, replaced by an overwhelming urge to stop the pain. This is why most investors make their worst decisions during market corrections. The rational mind, that carefully analyzed the investment case months earlier, gets overridden by panic. In online forums and social media, this panic becomes contagious. Someone posts their losses, others share their fear. Speculation spreads about further declines. A collective anxiety builds that has little connection to fundamental value. Professional traders understand this psychological dynamic and exploit it. They know that retail investors will panic sell near local bottoms. They position themselves to absorb this supply at depressed prices. This isn't conspiracy. It's simply experienced market participants taking advantage of predictable human behavior. The question is, which side of that transaction do you want to be on? We can't discuss precious metals movements without examining the currency backdrop, particularly the US dollar. Gold and silver are priced globally in dollars. When the dollar strengthens significantly against other major currencies, it creates mathematical downward pressure on dollar-denominated commodity prices. Think about it from the perspective of a European or Asian investor. If gold stays the same price in dollars, but the dollar appreciates 10% against the euro, gold just became 10% more expensive for European buyers. Demand naturally softens. Simultaneously, interest rate expectations play a crucial role. Precious metals generate no yield. They simply sit there, storing value but producing no income. When risk-free interest rates rise substantially, the opportunity cost of holding non-yielding assets increases. An investor facing a choice between gold generating 0% and treasury securities generating 4 or 5% must seriously reconsider their allocation. The higher rates climb, the more attractive yield-bearing instruments become relative to precious metals. This isn't a value judgment about gold's worth. It's simply rational portfolio mathematics. Different market conditions favor different asset classes. The recent shockwave involved both currency strength and interest rate recalibrations. These two forces combined to create particularly intense pressure on precious metals prices. For years, the investment case for gold and silver centered heavily on inflation protection. The narrative was straightforward. Central banks printing unprecedented amounts of money would inevitably debase currencies and spike inflation. Precious metals would preserve purchasing power while paper currencies deteriorated. This narrative drove enormous capital into gold and silver during 2020 through 2024. It made intuitive sense, it had historical precedent, and for a period, it appeared to be playing out exactly as predicted. But markets are not linear. Narratives that seem unassailable eventually shift. What happened recently involved a recalibration of inflation expectations. Whether due to economic cooling, policy effectiveness, or structural factors, the market's consensus forecast for long-term inflation moderated. This doesn't mean inflation disappeared. It means the extreme scenarios that drove the most aggressive precious metals positioning appeared less likely. And when extreme scenarios lose credibility, assets positioned for those extremes come under pressure. Again, this isn't about right or wrong. Markets don't trade on objective reality. They trade on the collective expectations of participants about future reality. When those expectations shift rapidly, prices adjust rapidly. One of the most destructive forces during any market correction is leverage unwinding. Many participants in precious metals markets use borrowed money to amplify their positions. In rising markets, this leverage magnifies gains, but in declining markets, it creates forced selling that accelerates the decline. Here's how it works. An investor buys gold with 50% borrowed funds. If gold rises 10%, their equity rises 20%. Leverage works beautifully on the way up. But if gold falls 10%, their equity falls 20%. And if it falls enough to threaten the lender's collateral, they receive a margin call. They must either deposit more cash or sell positions. Often, they must sell at exactly the worst time, when prices are already declining rapidly. This forced selling creates additional downward pressure, which triggers additional margin calls for other leverage participants. A cascade develops that has nothing to do with fundamental value and everything to do with the mechanics of borrowed money. The recent correction almost certainly involved significant leverage unwinding. The speed and magnitude of the price decline suggests forced selling, not careful fundamental reassessment. Understanding this matters because it helps you distinguish between price movements driven by genuine value reassessment versus those driven by technical market structure. The former may represent new information about asset value. The latter often represents temporary distortion that eventually corrects. We should briefly acknowledge the geopolitical dimension, though without veering into speculation. Precious metals prices have always been sensitive to global stability and confidence in the international monetary system. Major shifts in geopolitical relationships, trade patterns, or power dynamics influence how investors think about monetary insurance. The $6 trillion figure likely encompasses some sovereign-level repositioning related to these factors. Nations adjusting their reserve compositions or hedge positions create ripples throughout commodity markets. These movements happen largely out of public view. We see the price effects before we understand the causes. Trying to trade based on geopolitical speculation is generally futile for individual investors. What matters is recognizing that these forces exist and accepting that you cannot fully predict or control them. This acceptance should inform your position sizing and risk management, not your day-to-day trading decisions. Modern markets are dominated by algorithmic trading systems that execute based on mathematical models, not human judgment. These systems react to price movements, volatility changes, correlation breakdowns, and various technical indicators with machine speed and precision. When multiple algorithms trigger sell programs simultaneously, price declines can become remarkably swift. This creates an environment where corrections happen faster and more violently than in previous decades. The trading infrastructure itself amplifies volatility. For human investors watching their screens, this feels chaotic and frightening. Prices fall too fast to process. Traditional market analysis seems useless. Panic sets in. But understanding that much of this movement is algorithmic, not fundamental, provides crucial perspective. Algorithms don't care about long-term value. They execute programmed rules. When those rules are satisfied, the algorithmic pressure subsides. This is why corrections often see sharp V-shaped recoveries. The fundamental value didn't change. The algorithmic pressure simply exhausted itself. Stepping back, this entire episode reinforces several timeless principles about market cycles. First, nothing moves in a straight line. Every sustained trend eventually experiences violent corrections that shake out weak holders and reset technical conditions. Second, the magnitude of the correction often relates to the preceding advance. The sharper the run-up, the sharper the potential pullback. Markets have a homeostatic tendency to revert toward equilibrium. Third, maximum pain occurs at maximum uncertainty. The correction feels worst precisely when it's most difficult to imagine recovery. This is by design. Markets need to create sufficient pain to change behavior and redistribute holdings. Fourth, corrections end not when news improves, but when selling exhausts itself. The bottom arrives when the last weak holder capitulates, not when fundamental conditions brighten. Fifth, those who maintain perspective and liquidity during corrections position themselves for the next advance. Every brutal correction creates the setup for future opportunity. These principles apply across all asset classes and time periods. They are as close to market laws as anything in this uncertain domain. If you currently own gold or silver, you're facing several distinct choices. Let's think through them systematically. First, you need to reassess your original investment thesis. Why did you buy precious metals? What conditions were you hedging against? Have those conditions fundamentally changed, or has only the price changed? This distinction is crucial. If you bought gold as insurance against currency debasement and sovereign debt problems, has this correction resolved those underlying concerns? Or has it simply made your insurance temporarily cheaper to hold? If your thesis remains intact, then price decline represents noise, not signal. Your position size might need adjustment for risk management, but your core holding makes sense to maintain. If your thesis has genuinely changed, If you now believe the conditions that motivated your purchase are no longer relevant, then honest reassessment might suggest reducing or exiting positions. This isn't failure, it's adaptation. Most investors, however, fall into a third category. Their thesis hasn't changed, but their emotional state has. The pain of watching values decline creates a desperate urge to act. This is where discipline separates successful long-term investors from those who consistently buy high and sell low. You must distinguish between rational reassessment and emotional reaction. A useful exercise: write down exactly why you would sell now. If your reasons are primarily about price pain and fear of further decline, you're likely about to make a mistake. If your reasons are about genuine thesis and validation, you might have legitimate grounds for repositioning. Regardless of your thesis, this correction should prompt risk management review. The fundamental rule: never hold positions so large that their fluctuation threatens your psychological or financial stability. If this correction caused you genuine distress, your position was probably too large. This isn't a moral judgment, it's practical wisdom. Positions that are too large force you to pay attention constantly. They hijack your emotional state. They make rational decision-making nearly impossible. The appropriate position size in precious metals depends on your overall portfolio construction, your time horizon, your other assets, and your personal risk tolerance. There's no universal answer. But a useful guideline: your precious metals holdings should be large enough to matter if your hedging thesis proves correct, but small enough that you can sleep soundly when they correct sharply. For most investors, this means somewhere between 5 and 15% of investable assets. If you're significantly above this range, this correction might be an opportunity to right-size. Not to abandon the position entirely, but to bring it back into proportion with your overall portfolio strategy. If you're within appropriate ranges and your thesis remains intact, consider this correction as confirmation that your risk management was sound. You sized correctly precisely so you could weather this volatility without panic. One of the most dangerous impulses during corrections is aggressive averaging down, buying more as prices fall to lower your average cost. This can work beautifully if you correctly identify a temporary dislocation in a fundamentally sound asset. It can destroy portfolios if you're catching a falling knife in an asset entering long-term decline. The middle path: modest, scaled additions. If you have dry powder available and your thesis remains intact, the key word is modest. Don't double your position. Don't go on margin. Don't deploy capital you might need for other purposes. If you were planning to accumulate precious metals gradually over time anyway, this correction makes current purchases more attractive from a value perspective. But only if your timeline is truly long-term and your capital is genuinely patient. The worst version of averaging down involves using margin or selling other positions to buy more of a declining asset. This compounds your concentration risk at exactly the wrong time. Resist this urge. The hardest part of navigating corrections isn't technical analysis. It's maintaining emotional equilibrium. You will see other investors capitulating. You will read bearish analysis predicting further carnage. You will feel isolated in holding positions that are declining. These feelings are normal and predictable. What separates successful investors is the ability to sit with discomfort without reactively acting to relieve it. Discipline means doing nothing when nothing is the right move. This requires building some distance between your portfolio value and your emotional state. Your net worth is not your self-worth. A position declining doesn't make you foolish. Markets fluctuate. This is their nature. Practical techniques help. Reduce how often you check prices. Avoid forums and social media during heightened volatility. Focus on inputs you control: your risk management, your position sizing, your decision-making process, rather than outputs you don't control, like daily price movements. Remember that every past correction looked permanent while it was happening. Every recovery seemed impossible before it occurred. You're experiencing the same psychological pattern that has repeated throughout market history. This perspective doesn't eliminate discomfort, but it provides context that prevents discomfort from driving poor decisions. Now let's address those watching from the sidelines, wondering whether this correction represents an entry point. The honest answer is nobody knows. Not me, not celebrated analysts, not market gurus with television shows. Anyone claiming certainty about near-term price direction is either deluded or dishonest. What we can do is think through the considerations that should inform your decision. First, understand your motivation. Are you interested in precious metals as long-term portfolio diversification and insurance? Or are you hoping to catch a bounce and flip for quick profit? The former is potentially rational. The latter is speculation dressed as investment. Know which game you're playing. If you're genuinely interested in long-term precious metals exposure, corrections like this create better entry points than buying during strength. Not because we know the bottom is in, but because your average cost will be lower and your position will have more room to work if conditions eventually turn favorable. The way to do this sensibly is through scaled entry, not deploying all intended capital at once, but building positions gradually over weeks or months. This prevents the psychological damage of buying immediately before another leg down. Scaled entry might work as follows. Decide on your target allocation. Perhaps you want 5% of your portfolio in precious metals. Deploy 1/3 of that capital now. Wait 2 weeks. Deploy another third regardless of whether prices are higher or lower. Wait another 2 weeks. Deploy the final third. This approach accepts that you can't time the exact bottom. It distributes your risk across time, and it prevents the paralysis of waiting for perfect entry that never arrives. Some investors prefer rule-based entry tied to technical levels or time intervals. Others use value averaging, where they invest more on down days and less on up days. The specific method matters less than having a systematic approach that removes emotional decision-making. The critical thing is avoiding the temptation to go all in because prices are down sharply. What looks like a great entry today might look expensive if prices fall another 20% tomorrow. Preserve capital to continue adding if conditions warrant. Potential investors must also consider the form of their precious metals exposure. Physical metal, coins and bars you hold directly or in allocated storage, provides genuine ownership independent of financial system stability. But it involves storage considerations, insurance costs, wider bid-ask spreads, and less liquidity. Paper alternatives, ETFs, mining stocks, closed-end funds, offer convenience, liquidity, and lower transaction costs, but they introduce counterparty risk and in some cases tracking error. For most investors seeking portfolio diversification, a combination makes sense. Core physical holdings for genuine insurance value, supplemented by paper positions for tactical flexibility and ease of management. The recent correction likely created similar percentage declines across both physical and paper markets. So from a value perspective, the choice is largely personal. The question is about your priorities, maximum security or maximum flexibility. Any capital deployed into precious metals is capital not available for other investments. This opportunity cost must factor into your decision. In an environment where risk assets are cheap broadly, precious metals compete with stocks, real estate, and other alternatives. In an environment where defensive assets look attractive, precious metals compete with high-quality bonds and cash. Think about the full landscape of opportunities available at this moment. Has this correction made precious metals the most compelling value available, or are there better risk-reward opportunities elsewhere? This isn't about market timing. It's about rational capital allocation based on your assessment of relative value across asset classes. Sometimes the best decision about precious metals is not to buy them, even when they're down sharply, because something else represents better value given your specific circumstances and outlook. Finally, potential investors must be ruthlessly honest about their time horizon. If you might need this capital within 1 or 2 years, precious metals are probably inappropriate regardless of how attractive current prices seem. These markets can remain depressed for extended periods. Being right, eventually but illiquid when you need cash, is a failure mode. Precious metals make sense primarily for capital you can commit for 5 to 10 years minimum. This gives you enough time to weather additional volatility and benefit from eventual normalization or appreciation. If your horizon is genuinely this long, then whether you buy today or prices fall further in the near term matters relatively little. 5 years from now, the difference between buying at this price or 20% lower will likely be noise. But if you're hoping to flip these positions within months, you're speculating, not investing. And speculation during periods of heightened volatility is how accounts get destroyed. This section is crucial. Many investors understand what they should do in theory, but make predictable mistakes under pressure. Let's identify the most dangerous patterns explicitly. The single most destructive behavior is making portfolio decisions based on emotional state rather than rational analysis. Selling positions. Because watching them decline causes psychological pain is emotional trading. Buying back after prices have recovered because you feel you've missed the bottom is emotional trading. Checking prices constantly and adjusting positions based on hourly movements is emotional trading. All of these behaviors feel active and responsible while you're doing them. Your mind generates seemingly rational justifications for each action. But you're actually just reacting to discomfort and trying to regain a sense of control. The solution is not superhuman willpower. It's building systems that prevent emotional decision-making. Set rules for when you'll review positions, perhaps quarterly, not daily. Make decisions about position changes when markets are closed and you're calm, not during live trading when adrenaline is flowing. We discussed this in analysis, but it bears repeating as a warning. Using borrowed money to buy precious metals is extraordinarily dangerous. The mathematics seem attractive. Why buy with only your own capital when you can control larger positions through margin? If you're confident prices will rise, leverage amplifies returns. But confidence is not knowledge. And leverage transforms manageable losses into account-destroying catastrophes. During corrections, leveraged positions generate margin calls that force selling at exactly the worst moment. You lose not only your capital, but the ability to participate in eventual recovery. Professional traders use leverage, certainly, But they also have sophisticated risk management systems, deep reserves, and psychological training. Most individual investors have none of these advantages. The simple rule: if you can't afford to own it with cash, you can't afford to own it at all. Full stop. After suffering losses, investors often become obsessed with getting back to even. They refuse to sell or adjust positions until their original purchase price is achieved again. This is arbitrary anchor bias, not rational portfolio management. The market doesn't know or care what you paid. Your purchase price has zero relevance to where prices should go in the future. The rational question is always, given everything I know now, is this the best use of this capital? If the answer is yes, hold. If no, adjust. Your historical entry point shouldn't factor into this analysis. Waiting to get even often means holding positions long after your original thesis has failed, sacrificing opportunity cost, and making eventual losses larger than necessary. Some investors become so convicted about a particular thesis that their portfolio becomes dangerously concentrated. Perhaps precious metals make up 40 or 50% of total assets. Or worse, a single position dominates, silver but not gold, or particular mining stock. This concentration means portfolio outcomes are binary. You're either spectacularly right or spectacularly wrong. There's no middle ground. Diversification isn't cowardice. It's acknowledgement of uncertainty. You can maintain strong conviction about precious metals' long-term value while still keeping them as a meaningful but appropriately sized piece of a larger portfolio mosaic. If this correction revealed that you're over-concentrated, use partial recovery to rebalance. Your future self will thank you. The opposite error is endless analysis without action, waiting for perfect clarity that never arrives. Some investors consume dozens of expert opinions, watch countless videos, read hundreds of articles, and still cannot make decisions. They're searching for certainty that doesn't exist. Markets are inherently uncertain. Perfect information isn't available. At some point, you must act on incomplete data based on reasonable judgment. Set parameters for decision-making. Gather information for a defined period, perhaps a week. Weigh the key considerations, make a decision, implement it, move forward. Waiting for absolute confirmation means you'll always enter late, after the easy gains have already occurred. Wisdom is making reasonable decisions with uncertain information, not achieving certainty before acting. During volatility, social proof becomes overwhelming. If everyone seems to be selling, shouldn't you sell too? This herd behavior is precisely what creates extremes of overvaluation and undervaluation. When everyone has reached the same conclusion, that consensus is probably already reflected in prices. The best opportunities often come from positioning against consensus, not with it. Not contrarian for its own sake, but independent analysis that happens to differ from crowd sentiment. This requires intellectual confidence and emotional independence. You must be comfortable being potentially wrong in isolation rather than definitely wrong in company. Particularly for those in taxable accounts, trading decisions have tax consequences that can significantly affect net returns. Panic selling positions at a loss might trigger wash sale rules if you rebuy within 30 days. Taking short-term capital gains as you trade in and out means giving substantial portions of profits to government. This doesn't mean never selling or adjusting positions. It means factoring tax efficiency into your decision-making process. Sometimes the right move is holding longer than optimal from a pure price perspective because avoiding short-term capital gains treatment makes more sense for your specific situation. Finally, beware of anyone claiming to know where the bottom is or when the correction will end. Market bottoms are only definitively identified in retrospect. In the moment, every level looks like it could go lower. Smart analysts make educated guesses, but they're still guesses. Anyone promising they've identified the exact bottom is either ignorant of market complexity or deliberately misleading you. Competent analysts speak in probabilities and scenarios, not certainties. Your decision-making should acknowledge this uncertainty. Build positions as if prices could go lower because they might. Maintain liquidity as if you'll have future opportunities because you will. Avoid betting everything on having perfectly timed an entry. We've covered substantial ground together. Let's bring it home. The $6 trillion shockwave that crushed gold and silver prices is ultimately one data point in the much larger story of precious metals' role in modern portfolios. It's significant, certainly. But it's not unprecedented, and it won't be the last such episode. What separates investors who thrive long-term from those who get shaken out repeatedly is not superior prediction. Nobody consistently predicts these movements. What matters is preparation, discipline, and perspective. Preparation means sizing positions appropriately for volatility. It means maintaining liquidity to adjust as conditions evolve. It means understanding your thesis clearly enough to know when it's invalidated versus merely challenged. Discipline means following your process even when it's uncomfortable. It means not checking prices hourly. It means not panic selling near lows or FOMO buying near highs. It means treating investing as the patient deployment of capital, not entertainment. Perspective means remembering that markets have experienced violent corrections throughout history and continued functioning. It means recognizing that your portfolio is a tool for building long-term financial security, not a scoreboard measuring your daily intelligence. If you're currently holding precious metals through losses, extend yourself some grace. You didn't fail. Markets fluctuated. If your original thesis remains sound and your position sizing was appropriate, you're exactly where you should be. Ignore the noise. Trust your process. If you're evaluating whether to enter these markets now, take a systematic approach. Build positions gradually. Accept uncertainty. Focus on what you can control, your position sizing, your time horizon, your risk management, and release attachment to outcomes you cannot control. For everyone, regardless of current positioning, remember this. Wealth is built over decades, not days. Single market events, no matter how dramatic, matter far less than consistent behavior applied over long periods. The investors who succeed long-term aren't those who dodge every correction. They're those who maintain their course through volatility, learn from each episode, and continuously refine their process. This correction taught us something about market structure, about our own psychology, about the forces that can rapidly shift prices. That education has value regardless of profit or loss. Integrate these lessons, improve your approach going forward, and recognize that in 5 or 10 years, when you look back at this moment, it will likely appear as one small wave in a much larger ocean. The question is whether you'll have used this episode to build wisdom and discipline, or whether you'll have, don't let it shake you out of positions you should have maintained or into positions you should have avoided. The choice, as always, is yours. Markets will continue fluctuating. Crises will continue emerging. Corrections will continue happening. Your success depends not on avoiding these realities, but on developing the perspective and discipline to navigate them effectively. Stay rational, stay disciplined, stay focused on long-term objectives rather than short-term market noise. The path forward isn't about predicting the next move in gold or silver. It's about building a robust approach to portfolio management that can weather whatever markets deliver. You have the tools now. You understand the forces at work. You've considered the relevant factors for your specific situation. What happens next depends on whether you can implement this understanding with consistency and discipline over time. That's the real challenge, and that's where real wealth is ultimately built. Thank you for your time and attention. I hope this analysis has provided value and clarity. Whatever decisions you make from here, I wish you wisdom, discipline, and long-term success.